September the 15th, 2008. Lehman Brothers files for bankruptcy. $613 billion in assets. The largest bankruptcy in American history. Markets freeze overnight. Money market funds break the buck. Credit markets seize. Banks stop lending to each other. The financial infrastructure that moved money between institutions seized up. Lehman wasn't just another bank failing. It was the moment an entire financial system nearly collapsed. 158 years of history gone. But here's what makes this different. The warning signs were visible for months. Regulators knew. Competitors knew. Lehman's own risk managers knew. And no one stopped it. This is the story of how Wall Street's fourth largest investment bank brought the global economy to its knees, and how the system that created it still exists today. Lehman Brothers didn't begin as reckless. Founded in 1850 in Alabama, it started as a dry goods store. Over decades, it evolved into a cotton trading firm, then a commodities broker, then a full investment bank. By the 2000s, Lehman was a Wall Street titan. It had survived the Civil War, the Great Depression, multiple recessions, 2 world wars. 158 years of history created an illusion. Too old to fail. That's what people believed. Lehman advised on some of the biggest corporate deals in history. It traded billions in bonds daily. It employed over 25,000 people across the globe. Inside Lehman, there was a culture of superiority. Employees believed they were smarter than competitors, more disciplined, more sophisticated. The firm's CEO, Dick Fuld, had been there since 1969. He climbed from trading commodities to running the entire company by 1994. Fuld was known for his intensity, aggression, absolute control. Employees called him the gorilla. He ruled Lehman with an iron fist, questioned nothing, tolerated no dissent. There was a problem with this arrogance. It wasn't just personality, it was institutional. By 2006, Lehman's compensation structure created a specific incentive. Traders made money fast, took risk, got paid immediately. The risk managers who warned against it, they had no authority to stop anything. They filed reports, internal memos. Nobody listened. Internal warnings about mortgage portfolio concentration were documented, but overruled by senior management. Lehman kept hiring traders, kept expanding, kept moving money into mortgages. Because in 2006 and 2007, stopping felt like losing. Under Fuld, Lehman transformed. It moved away from traditional advisory work. Instead, it started taking bigger risks, trading more, investing its own capital into complex assets. By 2007, Lehman was heavily invested in mortgage-backed securities. Bonds created from thousands of home loans bundled together. The logic seemed simple. Housing prices always go up. Mortgages are safe. The more you hold, the more you profit. Except housing prices don't always go up. And the mortgages Lehman held weren't safe. Many were subprime, loans given to borrowers who couldn't afford them. High risk, high default rates. But Lehman kept buying because everyone else was. Because ratings agencies said they were safe, because the profits were enormous. By early 2007, Lehman held over $85 billion in mortgage-related assets. It was one of the most exposed firms on Wall Street. Everything looked profitable until it wasn't. Lehman didn't just invest heavily in mortgages, it borrowed heavily to do it. By 2007, Lehman's leverage ratio was over 30 to 1. For every dollar of capital, it borrowed 30 more. This amplified profits when markets rose, but it amplified losses when they fell. And they were starting to fall. In early 2007, cracks appeared in the housing market. Foreclosures rose. Subprime lenders collapsed. Housing prices began dropping. Lehman's mortgage holdings started losing value. But instead of cutting losses, Lehman doubled down. It kept buying mortgage securities, kept increasing leverage, kept projecting confidence. Fuld believed the market would recover. He told investors Lehman was strong. The losses were temporary. But internally, Lehman had a bigger problem. The firm was using an accounting trick called Repo 105. Here's how it worked. At the end of each quarter, Lehman would temporarily sell assets to another entity. Technically, this counted as a sale, not a loan. Days later, Lehman would buy the assets back. But during those 5 days, the assets disappeared from Lehman's balance sheet. This made the firm's leverage look lower, made the financials look healthier. It was balance sheet window dressing, designed to temporarily reduce reported leverage. According to the Bankruptcy Examiner's report, between 2007 and 2008, Lehman used Repo 105 to move over $50 billion off its balance sheet at quarter end. This wasn't a small adjustment. It was a systematic deception designed to fool regulators and investors about how much risk Lehman was taking. And it worked for a while, because no one was looking closely enough. By mid-2007, warning signs were everywhere. Bear Stearns, another investment bank heavily exposed to mortgages, nearly collapsed in March 2008. JP Morgan bought it in a fire sale with government backing. The message was clear. Mortgage exposure was toxic. Lehman's own risk managers started sending internal memos, warnings about the firm's exposure, suggestions to cut positions and reduce leverage. Fuld dismissed them. He believed Lehman was different, stronger, better managed. Credit rating agencies kept giving Lehman high ratings. Standard & Poor's, Moody's, Fitch all said Lehman was stable. These agencies were supposed to assess risk independently. Instead, they enabled it. Why? Because Lehman paid them for ratings. The agencies had conflicts of interest built into their business model. Downgrading a major client meant losing revenue. So they didn't. Regulators weren't much better. The Securities and Exchange Commission had oversight of investment banks. But the SEC didn't dig deep. It relied on the bank's own risk models. It trusted the ratings agencies. There's something worth understanding about how ratings agencies worked. They rated the same mortgage-backed securities that investment banks created. Then those banks paid them for the rating. This wasn't hidden. It was a business model. In 2007, Moody's and Standard & Poor's were upgrading mortgage securities even as foreclosures accelerated, even as default rates spiked. One internal email from a Moody's analyst, revealed later, said the models they used were fundamentally flawed. They kept using them anyway. Why? Because downgrades meant fewer deals. Fewer deals meant less revenue. The conflict of interest wasn't accidental. It was structural. The agencies could have been independent. They chose not to be. When Lehman filed its quarterly reports, the SEC accepted them, even though Repo 105 was distorting the numbers. Meanwhile, some of Lehman's competitors quietly started reducing exposure. Goldman Sachs pulled back. So did JP Morgan. They saw the risk building. They hedged. But publicly, no one said anything. By early 2008, Lehman's stock price started falling. Investors were getting nervous. Fuld tried to raise capital. He approached sovereign wealth funds, private equity firms, anyone who might inject cash. Korea Development Bank expressed interest, then walked away. Some smaller investors came in, but it wasn't enough. Lehman needed billions, and no one wanted to take that risk. By summer 2008, Lehman was running out of time. September the 12th, 2008, Lehman's stock collapses. The firm is bleeding cash. Clients are pulling deposits. Trading partners refuse to do business. Treasury Secretary Hank Paulson calls an emergency meeting at the Federal Reserve Bank of New York. Every major Wall Street CEO is summoned. Bank of America, Barclays, Goldman Sachs, Morgan Stanley, Citigroup, JP Morgan. The message is simple: find a buyer for Lehman, or it collapses. Two potential buyers emerge. Bank of America expresses interest, but within 24 hours, it pulls out. Instead, it announces it's buying Merrill Lynch, another struggling firm. That leaves Barclays. Barclays wants to buy Lehman. The deal would make sense. It would give Barclays a major Wall Street presence. But there's a problem. Under UK law, Barclays needs approval from British regulators for a deal this large, and the British government refuses to guarantee Lehman's liabilities during the transition. Without that guarantee, Barclays can't proceed. The deal collapses. By Sunday, September the 14th, Lehman has no buyer. Paulson makes a decision. The US government will not bail out Lehman. 6 months earlier, the government had helped rescue Bear Stearns, but Paulson believes another bailout would create moral hazard. It would signal that banks can take unlimited risks, knowing the government will always step in. So Lehman is left to fail. Political calculus is clear. Draw a line. Show markets that failure has consequences. On Monday morning, September the 15th, 2008, Lehman Brothers files for Chapter 11 bankruptcy, the largest bankruptcy in American history, and the financial system breaks. The collapse is immediate. Lehman's bankruptcy triggers panic across global markets. Firms that lent to Lehman face massive losses. Counterparties scramble to unwind positions. Credit markets freeze. Banks stop lending to each other. The interbank lending rate spikes. Normally a sign of smooth operations, it now signals total distrust. Money market funds, considered among the safest investments, start breaking the buck. Investors lose money. Panic spreads. People start pulling cash out of funds. Institutions hoard liquidity. Within days, the contagion spreads globally. Just 48 hours after letting Lehman fail, the government reverses course. AIG, the world's largest insurance company, is on the brink. The government steps in with an $85 billion bailout. Then, Washington Mutual fails, the largest bank failure in US history. Wachovia nearly collapses. Wells Fargo buys it in an emergency deal. In the UK, the government nationalizes multiple banks. In Europe, governments inject billions into financial systems. Iceland's entire banking sector collapses. The country goes bankrupt. Stock markets crash. The Dow Jones loses half its value within months. The global economy enters the worst recession since the Great Depression. Millions lose their jobs. Trillions in wealth evaporate. Retirement savings disappear. Governments worldwide are forced to intervene. Bailouts, stimulus packages, central banks slashing interest rates to zero. The US passes the Troubled Asset Relief Program. $700 billion to stabilize the banking system. The debate erupts immediately. Moral hazard. Should taxpayers bail out banks that caused the crisis? Should executives who took reckless risks be rescued? But the alternative is worse. Letting more banks fail would trigger a complete collapse. So governments bail them out, and the public watches, furious. After the collapse, investigations begin. The Lehman bankruptcy examiner, Anton Valukas, releases a 2,200-page report in 2010. It details everything: Repo 105, the balance sheet manipulation, the ignored warnings, the reckless leverage. The report concluded that Lehman's leadership was aware of the firm's growing risks and the effect of its accounting practices. They chose to hide risk rather than reduce it. But here's what doesn't happen. No major criminal convictions. Dick Fuld testifies before Congress. He's grilled for hours. Congressman Henry Waxman holds up a chart showing Fuld made over $500 million during his tenure. Fuld insists he lost most of his wealth when Lehman collapsed. He says he feels terrible about what happened, but no charges are filed. The legal argument is that Lehman's behavior, while reckless and deceptive, wasn't technically illegal under existing law. Repo 105 exploited loopholes. It wasn't explicitly banned. Other Lehman executives face civil lawsuits. Some settle, some pay fines, but no one goes to jail. Meanwhile, ordinary Lehman employees lose everything. Stock-based compensation becomes worthless. Retirement account balances tied to Lehman equity collapse. But senior executives? Many had cashed out millions in bonuses years earlier. The public watches, sees banks bailed out, sees executives walk away wealthy, sees ordinary people lose homes, jobs, savings. The anger is immense. Protests erupt. Occupy Wall Street forms in 2011. The movement spreads globally, but the fundamental system doesn't change. Lehman mattered more than Bear Stearns. When Bear Stearns collapsed in March 2008, the government stepped in. Markets believed a precedent had been set. Banks assumed they'd be rescued if things went wrong. Then Lehman failed, and the assumption shattered. Confidence, it turns out, is the real currency of modern finance. Banks don't collapse because they run out of money. They collapse because people stop believing they're solvent. Lehman had assets, but when clients and counterparties lost confidence, those assets became worthless overnight. No one would lend. No one would trade. The bank became illiquid. And in modern finance, illiquidity equals death. The lesson from Lehman isn't just about one bank's failure. It's about systemic fragility. Financial institutions are interconnected. When one major player fails, the shockwaves spread instantly. Credit freezes. Markets panic. Contagion spreads. After the crisis, regulators introduced reforms. Dodd-Frank in the US, Basel III internationally, higher capital requirements, stress tests, restrictions on risky trading. But the fundamental structure didn't change. Banks are still heavily leveraged, still interconnected, still reliant on confidence. The debate about moral hazard remains unresolved. Should governments bail out failing banks to prevent systemic collapse, or let them fail to discourage reckless behavior? Lehman was allowed to fail. The result was catastrophic. But bailing out every bank creates a different problem. It encourages risk-taking. If firms believe they'll be rescued, they have no incentive to be prudent. The real problem isn't bailouts or no bailouts. The real problem is a system designed to require them. This can happen again. Not the same way, not with the same players, but the conditions that created Lehman still exist. Excessive leverage, regulatory blind spots, interconnected institutions. The belief that this time is different. Lehman Brothers didn't fail because of one bad decision. It collapsed because risk, leverage, regulatory blindness, and arrogance compounded silently. until the system snapped. Dick Fuld built Lehman into a leverage machine. He ignored warnings, manipulated balance sheets, bet everything on housing. And for years, it worked. Because everyone wanted to believe. Investors wanted returns. Employees wanted bonuses. Regulators wanted to trust that banks could manage their own risk. No one asked what would happen when confidence disappeared. Now, we know. Fuld walked away. Lehman is gone. Millions lost everything. But the system that created Lehman, still running.